We're looking at the market data for June 2024. As the headline's saying there, the Wellington market continues to be quite hard work. Message to sellers, it is pretty tough out there. You have to compete hard. Your property has to look good. Handle your maintenance issues and your items, and price it appropriately. Otherwise, you risk it languishing on the market. Buyers, you've got good conditions out there. Make the most of it. All of the data that we're going to look at tonight will basically support that message. On the ground, very recently, like the last 4 to 6 weeks, pretty much as a result of the new listing volumes seasonally slowing down, not slowing down compared to a year ago, or not slow generally for this time of the year. But obviously, as we go into winter, new listings volumes do decline, and typically it happens this way. This year is no exception. That as the volume of new listings dries up, as it comes to market, the buyers that are in the market and have been used to a certain level of new listing flow, they sort of get a little bit. The message they get when that flow slows down is, oh, I don't have quite the same luxury of being able to wait and knowing that there'll be several more that might suit me coming on every week. So they look more carefully at the stuff that is in front of them, and reconsider making offers on that stuff, whereas they might otherwise have let it go in the hope that the unicorn is about to turn up next week, sort of thing. Anyway, let's get into it. There's the median sale price. So if you look at the red line there, that shows us the trend. We've been broadly stable since July 2022. So 2 years now, we've been bouncing around that kind of high 700,000 level. As it happens, June 2023 to June 2024, 765 to 780, up 2%. 1 month it's down 1%. 1 month it's up 1%, 2%, down 2%. It's bouncing around those sorts of levels you see there. The last couple of months we've been high 700s. A couple of months before that we were early 800s. But overall the trend is fairly broadly stable-ish. As most of you will know, I don't pay too much attention to this because it reflects the mix of properties sold to a certain degree, not just their underlying values. And of course, it's underlying values that is what is most important to us. So let's look at that. The Real Estate Institute House Price Index. That's the league tables there, and Wellington Region has the honour of having led that table there in terms of the right-hand column showing how much have the values fallen, or where are the values at now compared to where they were at their peak. So now 24% down compared to their peak. You may remember, but in case you don't, we reached a low point of 26% down. We then recovered throughout 2023 to about 20% down. And so going from -26 to -20 is a recovery of about 8%. It sounds like 6%, but of course it's not. It's relative to the -26% position, up to 20% down, the recovery of about 8%. We've since then deteriorated back down from 20% down to 24% down. And yeah, so we are continuing to lead these league tables. If we look at the last year, over the last 3 to 6 months, Wellington's recovery has been really quite strong compared to the rest of the country. That is no longer the case over the last 12 months. We're pretty typical compared to the rest of the country, 1.4% up over the last 12 months in Wellington versus 1.3 nationwide. Stronger than Auckland, for example. And you'll see they're up and down that 1 year column. There's a mixed bag from quite strong results down in Otago at over 6%. Down to as low as -2.4% further sort of up in Northland. And over the last 3 months, you'll see that the deterioration in the Wellington values has been more significant than the rest of the country. And so this is really the result of 2 movements since the election. We had vendors who had been encouraged by the reasonably positive results throughout the first 3 quarters of 2000, well, really quarters 2 and 3 of 2023, where we saw prices recovering, we saw amount of stock on the market reducing, we saw the duration to sell contracting, so improving conditions for sellers. The sellers was encouraged by that, decided, look, I'm going to bring my plans back onto the table again. I've been putting my plans off. I can only do that for so long. It seems like a reasonable time, but I want to wait till the election's out of the way. And so once the election was out of the way, we saw an absolute flood of new stock coming to the market. As a result, the number of new listings, sorry, the amount of supply overall in Wellington City went from about 465 listings in Wellington City on TradeMe the week of the election to 920, literally a doubling of the amount of available supply on the market. All those new listings coming on as vendors came back to the table at the same time as buyers got new uncertainty and pulled back from the table because of well, the main change as a result of the election was fresh uncertainty around the public sector labour market, which of course is a Wellington-centric phenomenon. As a result, prices or values in Wellington softer over the last 3 months, in particular 3.5%, more than any other region of the country. So house price index now, there's the graph looking at the Wellington region. So 1.4% up over the last year, down 3.5% the last 3 months, down 1.5% the last 1 month. You see the shape of the graph there. We were showing reasonably firm recovery in the quarters 2 and 3 of 2023. From late 2023, we saw it starting to tail off there. And the last, well, throughout the balance of 2024, really, it's been a softer market with values pulling back slightly, and that graph has indeed gotten slightly steeper over the last 6 months. Orange line, of course, being the last 3 months, and the blue line being the 1 month result. So over the last year, in terms of the different territorial authorities, so Wellington City, absolutely level, 0% growth over the last year. Of course, we were up and then down again. So net effect 0. Lower Hutt City, reasonably similar. Firm growth in Upper Hutt and pretty good in Porirua also. Over the last 3 months, again, similar story, very, very soft in Wellington City and Lower Hutt City, 4% almost across both those territorial authorities over the last 3 months alone. Not quite as soft in Porirua and Upper Hutt, but all 4 of those negative. And I've commented on this before, the Wellington region at negative 3.5%, Wellington City negative 3.9%, Lower Hutt City negative 3.9%. There are 4 territorial authorities that make up part of the balance of the Wellington region, which are not included in that list there, and they are Kapiti, Masterton, Carterton, and South Wairarapa. And so that's why you sometimes you sort of look at those 4 numbers and you think, well, how can it be 3.5% on average? In this case, it can arithmetically make sense, but sometimes it doesn't, and when it doesn't, that's the explanation. And there is the Wellington City graph. So overall, you see Wellington City, it's a smaller territorial authority than the overall region, so it can bounce around a little bit more variability, and it tends to have greater extremes. So in the trough, we were down deeper. In the recovery, we were up higher, and this is no exception. We're down more than we are down across the region overall, although not by a terrific amount, 3.9% down versus 3.5% for the region overall. Still, the message is there, pretty relative weakness throughout 2024 overall, and that hasn't changed so far, at least not according to the data. On the ground, the sense is that actually it's not quite as tough as it was 4 weeks ago, 6 weeks ago, and I've got a little bit of data to sort of that hints towards that, but that's how it feels. And as I said before in the intro, that'll largely be because the amount of stock that we're having on, that the amount of new listings coming to the market is slowing down, as is typically the case in wintertime. So there's the new listing volumes. So the red line paints a very interesting picture there. We've had an enormous increase in new listing volumes since late-ish last year, as I mentioned, basically since the election. Very steep incline indeed. The amount of stock coming to the market in June at 532, although it's 50% more than June last year, it's broadly identical to what we saw 2 years ago. and it's significantly down on the 4 months prior to that. Of course, February, March, April, May. Now, that is not atypical, but the drop between May and June is major this time around, because we had a very, very big May for new listings. So June's significantly down on the last 4 months. And if we look at that's funny, I've got a line that's not missing there. That's not come through there, or is it? If I click it one more time, there it is. So we are back down to what would be typical levels of new listings for June, whereas in May, for example, we were well above typical listing volumes for May. So significant reduction compared to last month, and relatively speaking, not as extreme relative to 12 months ago either. Still 50% higher than last June. Last June was anemic for new listings. As I was saying, we were seeing in quarters 2 and 3 last year really low levels of new listings coming to market, and that is really what drove the recovery in the market, that gave the market the relative strength. So there's the graph in another format. So we're still seeing significantly more listings than we saw a year ago, but not to the same degree that we saw in February, April, and May, as you can see clearly in that graph. We're still 50% higher than a year ago. Is still an extreme variation compared to what we've seen over the last 8 or 9 years, as is evidenced by this graph here. Number of sales, and this is the other half of the picture really. We are not seeing a significant increase in the amount of sales coming to the market, as we have seen an increase in the amount of stock coming to the market. So let's just go back to that. Look at that red line there, a massive increase in new listing volumes. We are not seeing a massive increase in that, as evidenced by that red line, in the number of sales being made. Yes, it's an increase. So I don't know, from my perspective as a real estate agent, from my colleagues as real estate agents, we are making more sales. We get paid on sales. That is good news in that respect. But the gradient of that line is sluggish compared to the gradient of the line representing new stock coming to market. What does that mean for a seller? Obviously, as a seller, you're not concerned with the hundreds and hundreds and hundreds of listings that are on the market. You are concerned with your one. And the ratio of sales to listings is deteriorating. So the risk of not affecting a sale in a reasonable period of time is increasing. The risk that you're attracting no offers is increasing. The risk that it takes a long time is increasing. The risk that you're not going to achieve the price that you are hoping for is increasing. So overall, when you're looking at your one listing, it's a tougher market. If you're an agent and you're concerned with volume of sales for your livelihood, then it's a better market, although each listing is harder work, if that all makes sense. 475 sales this month versus 605 a year ago, 462 years ago. So broadly the same number of sales we were seeing 2 years ago. But remember, 2 years ago, the market was super tough. So it is still super tough. A year ago, the market was much better. Lower listing volumes, more sales. Things were looking good for vendors. So we're back down to pretty anemic levels there. And the red line you can see there shows that it was increasing. Now it's dipping down a little bit again. June sales volumes well below average again. So in May, if I remember rightly, we were above average sale volumes for May. We are back down to significantly fewer sales taking place compared to what's normal for the month of June. So yeah, reverting back to quite tough market conditions again. And there it is in another format. So as you can see there, we were seeing more sales taking place, and in some instances significantly more, typically between sort of 15 and 50% more sales taking place than the same month 12 months prior. In June, that has been reverted again, back down 21% compared to June last year. That being said, June last year was in the strong point in that sort of recovery part of the cycle. So you're not quite comparing apples with apples, but nonetheless, that's reflective of the current market conditions versus 6 and 9 months ago. How long is it taking to sell? Again, you can see a reasonably clear trend there. Throughout the really tough parts of the market in 2022, we were seeing properties take quite a long time to sell, 50 days, 60 days. In the last 12 months, things firmed sort of mid to late last year. We were seeing 32, 34, 35 days. Well, we're back up to 49 in June, and that's a big increase compared to relatively over the last 12 months. Compared to 12 months ago and 24 months ago in June, about the same. But we we were taking significantly fewer days than, shorter periods of time over the last 12 months generally. The duration to sell doesn't tend to bounce around a lot. It's reasonably consistent throughout the year, with the exception around Christmas time, when all of a sudden things slow right down and it tends to take a bit longer. But excuse me while I just let someone in. Yeah, so 49 days compared to what's normal at 38. Again, taking quite a long time to sell properties again in Wellington. So again, just a consistent message here. It's gotten tougher over the last 6 months or so for vendors, better for buyers. Inventory, how much stock we got on the market. This is how long does it take to clear the amount of supply we've got on if things continue to sell at the same rate. Again, you can see a consistent theme there. Consistently and gradually increasing levels of inventory. So we've seen 15 weeks worth of inventory for the first time. That's the highest we've seen basically in 12 months. Now, when we compare it to what's normal in terms of the long-term average, at least 15 weeks is spot on average. But that's talking about over the last 20 years or so. If we compare it to what's in more recent memory over the last 8, 9, 10 years, which is the duration that this graph here covers, we're more like 10 weeks. So over the last 2.5 years or so, we have seen inventory consistently longer than 10 weeks, which is why perhaps it has felt like a really tough market. As I say, if you go back further than sort of 8, 9, 10 years ago, we were seeing well more than 15 weeks worth of supply. And so once you average all of that across with the last 10 years as well, 15 weeks is what's the long-term average, and that's where we're at. So on that basis, it's technically an absolutely balanced market. But compared to what we're used to over the last 10 years, it's a tough market. 15 weeks versus 10 weeks worth of supply. And there's the TradeMe listing volumes. So you can see there a significant increase over the last 8 months or so since the election, as I was talking about. Part of that is just seasonal. As we come into summer, we get more, and then as we come out of summer, it declines, and we've seen that over the last 3 months or so, declining seasonal listing numbers there. But compared to what we saw a year ago, we are at significantly more than we saw a year ago now. 40% more than a year ago, 6% more than we saw even 2 years ago. So relatively speaking, we are still have a relative abundance in gross levels of supply. But the new levels, the new listings coming on has reduced, as is typical in wintertime, but still more than we've been seeing typically at this time of the year. So it is a complex picture for sure, but overall the sentiment is that it's been getting tougher over the last 6 months, significantly tougher for vendors in the Wellington region. So there's a summary. Wellington values have been softening again recently, but broadly throughout 2024 so far. New listings have increased versus June 2023, although they are decreasing, as is typical for this time of the year, just seasonally. Sales volumes are down seasonally and down versus June 2023. So whereas we're seeing more new listings relatively, we are not seeing more sales taking place relatively, and that makes it tougher. Duration to sell is longer for sure, well above average again. Inventory levels are normal for the long-term trends, but high relative to the last 10 years, so it certainly feels tough. TradeMe listings are up versus 12 months ago, but seasonally they are on their way back down again now, as is normally the case. As I say, sellers, the market certainly has been tough again. Buyers make the most of these favourable conditions. They never last forever. Big thanks, as always, to Real Estate Institute and realestate.co.nz. As I promised, I have a couple of sort of more bang up to the minute bits of data which show perhaps some easing of the tough conditions as a result, I suggest, of the fact that we're seeing supply levels coming down, as is normally the case in winter. And this is the irony of it. Much like it was ironic that a lot of sellers were thinking, look, I'm going to get back on with selling my property as they saw market conditions improving in 2023. They wanted to hold back till after the election because for some reason, knowing who's going to be in government changes whether they need to sell their house or not. Everyone did it, and then everyone brought their property on the market after the election, in thinking that that was the smart thing to do. In the end, the smartest thing to do was, in hindsight, sell a month before the election. And so it's always the case that, or not always, but it's very often the case that in order to beat the market, you have to zig when the market's zagging. You have to be a counter to what the rest of the market is doing as opposed to follow the herd. And it's typical for people to think when they're thinking of selling that winter is a bad time to sell. It's cold, it's miserable, the garden doesn't look as nice. But because everyone else thinks that way, the amount of new supply coming on during winter is relatively anemic. And so the buyers that are in the market, because buyers are in the market 24/7, 12 months a year, they see less stock coming to the market. And so they have to compete more aggressively for the supply that is coming on. And so actually every listing then gets more attention. And there are still people coming in. And so here is there's a summary of the data. I think we probably don't need to cover that, but here is the data I'm talking about here. So this is obviously, this is Low & Co data, so it's not the whole of Wellington data, but it will be still reasonably instructive. Low & Co has about 25% market share in Wellington City, not Wellington Region, of course, but it's the trend here that is most useful to look at, not the actual gross quantum. So the red line there shows on a monthly basis the average number of groups attending an open home. So you can quite clearly see there, as we came out of the boom market, we came into the tough market, the open home traffic was falling off a cliff here. We came into really tough times in early, mid, and even latest 2022. We were seeing average of 3-4 groups per open home. This is through the life of a campaign across all open homes. So obviously at the start of the campaign, the first open home is the busiest. It's not reflective of that. It's the average across all open homes. But still, we were in 2021, early 2021, 2020, we were seeing averages of 15 groups at open homes. So to come from 15 down to 3 or 4, that is a serious slowdown there. Throughout 2023, as I indicated, things got better. We saw open home traffic on average double. And then in latest 2023, round about that election time, we saw open home traffic again fall off the cliff. And then, oh goodness me, this is out-of-date data. I apologize. I thought I had the most recent one. I just put it on there like 40 minutes ago, but I've obviously grabbed the wrong file. And this shows the ongoing trend of declining open home traffic. Let's see if the numbers I've got here this is the numbers per listing. And so, sorry, offers per listing. So again, you can see here, offers per listing, early 2021, on average per listing, getting 3-4 offers per listing. Now, this is not on tender day or on deadline day. This is throughout the life of the campaign, but still we're seeing lots of offers per listing. Then that fell off a cliff as we entered into late 2021. It was anemic throughout the entire life of a listing, which could be 3 months, 4 months long. 1.4 offers in 4 months or 3 months. That is a slow rate of offers. Then as the market improved in early 2023, fewer listings coming to the market. The buyers had to concentrate on less choice, so the amount of offers per listing increased, and then since then it's been gradually decreasing again. Since the election in particular, it came right down here and it's been bumping along anemic levels. We're just starting to see an uplift here as we go from June to July. It feels like the market is not quite as tough. We'll see what this data looks like. Perhaps next month we'll look at it again, and I'll try to make sure we've got the up-to-date data on the open home front, as well as the number of listings there where we can see where obviously this is almost a full month for July, where we're sort of 3/4 of the way through July. So it'd be interesting to see what that looks like. But that's more reflective of that's activity on the ground, because of course the way it goes is activity levels lead the outcomes in terms of prices, numbers of offers, and so on. People have to look at properties before they make offers and buy them. And so the more activity there is, the more likely it is that prices will firm and duration to sell will shorten. And so this is suggesting perhaps we are through the toughest times, and we're also starting to see, when we're running open homes, some of the public servants are coming through saying, but they have been sort of really stuck in a quagmire of uncertainty. Some of that uncertainty has been alleviated now. They know who's losing their jobs and who's keeping their jobs. So a whole lot of people who are thinking, gosh, is my job at risk? They have now had it confirmed, no, their job is not at risk. And so a combination of fewer listings coming to market, as is typical in winter, combined with less uncertainty in the public sector labour market, and of course, we've got the prospect of reducing interest rates. So perhaps we might see conditions for sellers improve over the next 6 months. The key, of course, will be determined by how much property comes to market. As I've tried to say over and over again in this call, that is really the most, I suppose, instructive data, is how much property is coming on. If we've got a ton of property coming on, doesn't matter what interest rates are doing, it's going to be harder to compete for the buyers. All right, guys. Hey, thanks for checking in. See you next time. If anyone wants any individual advice, you know where to find me. Happy to talk. Sing out anytime. Take care. Have a good night.